You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. That rockin' tune means it's time once again for the option block. Everyone's favorite, at least I hope it's your favorite bi-weekly source for all things options related. If it's not your favorite, you kind of have a dearth of other options, pun intended there. So hopefully this is indeed at least one of your favorites. Of course, my name is Mark Longo from theoptionsinsider.com, as well as, of course, from a little thing we like to call around here, the old Options Insider Radio Network. Hopefully, maybe even this week, going to be expanding to beyond lucky number 13 into the 14th program on said network. So hopefully, fingers crossed, that'll be coming for you this Friday. Don't hold me to it. We're still dotting the I's and crossing the T's, but hopefully, if everything can come together, we'll get it going for you this Friday. Perhaps a little check-in on the world of futures options, which I know you guys want a lot more of. In the meantime, where can you check out all of our fine programming? Well, the easiest place, of course, the mothership, the flagship, theoptionsinsider.com. While you're there, of course, click on pretty much anything you want. You want to click on some breaking news on the options market? Hey, we got you covered. If you want to click on some education, well, got that for you as well. Unusual activity? Check. That's covered. Of course, a lot of breaking news and developments and trades and trends and analysis from all things in the world of options, including some professional industry stuff. Well, surf on over there. We got you covered throughout the day. And when your reading is exhausted, when you can't read anymore, click on that Insider Radio Network tab, and then your real odyssey has begun into the fine network that is the Options Insider Radio Network. Of course, you can also find us iTunes, TuneIn, Stitcher, so on and so forth. Hopefully sometime soon in the Google Play store whenever they turn on their podcast feature. I know some people seem to have it, others don't. So whenever they roll it out globally, you'll have access to that as well. Of course, also via our mobile app, available for iOS, Android, and the ever-exciting Fire OS. And speaking of ever-exciting, well, I wouldn't be talking about these guys, but they're joining me anyway. None other. Starting off in the land of Maine, where I'm sure he's taken some serious umbrage. The Rock Lobster himself, Mr. Andrew Giovinazzi, from a little place we also know around here as the Pit. Mr. Rock Lobster, welcome back to the program, sir.
Well, we could call it the land of umbrage, but actually I don't have there's no umbrage to take today. But volatility futures are flying after hours. Oh my gosh. Well, let's watch them go.
Because they know our show's starting. They want to give us something to talk about.
I guess so.
How kind of them to be so cooperative. Also joining us from a little bit closer to home, a little bit within the radius of good old Chi-Town, is a sleepy hamlet you may know as St. Charles, Illinois. And there, within the Google Maps, you will find the office of one Uncle Mike Tosaw from RCM Wealth Advisors. Uncle Mike, welcome back to the program. To you as well, sir.
Always happy to be here broadcasting live from the sleepy hamlet.
Whoever would have thunk that all those years ago that something would be happening live out there in the land of St. Charles. See, rocking and rolling. In fact, I think I can somewhere on my desk is still that great tourist brochure you brought me. So I'm planning my epic 3-month vacation to St. Charles as we speak, sir.
Gotta love it.
All right. Speaking of things you gotta love, it's time to love the trading block.
It's time to break down the latest topics, trades and trends in the world of options. It's time for The Trading Block.
All right, everybody. Welcome to The Trading Block, the portion of the program where we break down what was moving, what was shaking, what was rocking, and indeed rolling in the day that was from a broad market perspective. As we're wrapping it up here right after the bell here on Monday, April 11th. It's pretty much a mixed bag across the board, notwithstanding what Mr. Rock Lobster was just saying about the after hours. Pretty much the day was an interesting one. Had a bit of a range out there on the old S&Ps. We actually had a bit of a rally rolling. Then towards the end of the day, the S&P actually having about 20 handle range today, getting about as high as about 2062, getting as low. It's pretty much right about where we closed, about 2043 or so on the downs. Actually 2042 for the low, closing around 2043. Off fractionally on the day. Dow and the NASDAQ pretty much following suit, off slightly to close the session. And of course, with all this hither and yon, VIX cash taking a bit of an inhale today, up to nearly the 16 handle. I was leaning on the lower side of the spectrum for our vol views prognostications. So far, not so good, but I got a whole week ahead of me. That said, Mr. Rock Lobster, amidst all of the turmoil and tumult today, what caught your eye in today's trading activity, sir?
You know, it's gold and all the commodity stocks again just went, kablooey. GDX was up, I don't know, 6% or something like that. GDXJ, all the little miners. The miners led gold down the last time. It looks like they're leading gold up now. So pretty impressive. That's all I can say on that one. Pretty darn impressive. That, I think, is the story, and the fact we had kind of a solid turnaround. I guess we ended up eking out kind of almost an average true range of about, 0.8%. We were up some, and then it all just sort of went away by the end of the day. So, and just the fact that the ECB has negative rates, and we don't know how low they can go, and somehow that doesn't seem to matter to their currency whatsoever. So I guess it must be the most shorted currency in the world, because nothing seems to matter for it anymore. So it's just a day of kind of, I think the moves in the metals are really mostly just the gold and currency proxy stuff that's really making a big move.
Speaking of making the move, as we're talking around, I'm trying to bring up my future screen, but it sounds like you already have yours up. How are we looking out there in vol futures land?
It's definitely catching a bid. Of course, I don't know why, because the vol seems to be already fully priced. I mean, VIX crossed 16 on the upside, and so there's a bid for vol here at the end of the day. I don't quite get it, but it could be oil, could be this, could be everybody finally freaking out over something. Who knows? But I didn't see the real reason. I own too much gamma for us to crash, so nobody has to worry about that. It's not.
You just put the kiss of death on it, sir.
I believe me, we're not crashing. It ain't gonna happen because I own too much gamma. I can't get that lucky. So.
What fun would that be if the market worked in your favor one day, sir?
I know. So anyway, I think that's what we got. Just not a lot of. We have a lot of sideways action. We have some strange action in gold. Looks like hugely bullish action. It doesn't look like it's stopping anytime soon. And I think that's the result of central bankers throwing more fuel on the fire. And until they stop, we're going to have more of the same, I think.
Since we're talking gold, let's bring on the resident gold bug, Uncle Mike Tosaw. I'd imagine a little bit of GLD activity caught your eye. Let's walk through that a little bit, and then as well as whatever else may have caught your eye in today's upwards and then downwards activity.
Yeah, I think that with gold today, we had a nice rally on it. This is one where a lot of this rally actually came on the morning, and actually a lot of it came overnight, quite honestly. So for the most part, gold actually traded sideways throughout the day today. So a lot of this came from the overnight futures trading. We're still short puts on GLD. I still think it's a little bit too hot right now, and I still think it could pull back. But on the flip side, I'm still the resident gold bull. So what fun would it be to be the resident gold bull if I didn't have any bullish exposure on gold? With that being said, the thing that really caught my eye today for the most part was just this action today, and how initially we just opened a lot higher in the S&P, just shot right up. 9 o'clock we go down. We retrace a little bit after noon, and it has just been total. The bears have been in total control the rest of the day. So it's definitely been a very big down day on the day today, and I think just that's not surprising. With a lot of VIX futures buying, just based on the fast action to the downside with which we've had in the marketplace the last hour of the day. Individual stock names, nothing really too much nothing's really crashing right now by any means, at least the things with which I watch. But it is a down day today, not a significantly down day, but the movement to the downside is a wee bit concerning, considering how much it was from peak to trough throughout the day today.
Since we're talking volatility earlier and catching a bid, interesting piece out there in Bloomberg, and there are myriad different measures for volatility out there. Of course, the VIX, aka the fear gauge, being top of mind for most people, but everyone seems to have their own flavor, their own recipe on exactly how to measure this kind of thing. And Bloomberg had an interesting write-up this morning on what Credit Suisse, what they use, which is interesting. We've talked about the Skew index coming out of CBOE before and how they measure that. Credit Suisse has a variation, a different flavor on that one, if you will. They term it a little bit differently, which is kind of interesting. They look at how far out you have to go to purchase how far out of the money, of course, you have to go to purchase a 3-month put on SPX. That's the same price as a 10% out of the money, also a 3-month option. So AKA they're measuring 3-month out Skew effectively. But it's a bizarre way to do it. It leads to kind of a weird interpretation. And they were sending up all sorts of red flags today to the people over there at Bloomberg, saying that their gauge is seeing some interesting movements right now. But of course, as we've said on the show, when we take issue, maybe even Andrew takes umbrage with the Skew index in and of itself, because of the issues that can be caused by a variety of different things that can really impact the Skew numbers that they're throwing out there. Well, of course, when you have this kind of obtuse methodology of doing it this way as well, and you're seeing what's reflectively right now is not really showing a remarkable bid, and I think they even admit this in the article. It's not showing a strong bid to the puts, which would indicate a heavy fear of downside move, as much as it's not really showing a lot of love for the upside calls right now. You got to really do some work to find some calls that are catching bids out there in the S&P land right now. So kind of interesting. I think it's more worthy of note just for the fact that I wasn't that familiar with this particular flavor of fear gauge, aka Skew, call it what you will, this morning before I read this piece. So that was worthy of note in and of itself, even if in the same article they pretty much take a lot of steps to debunk it. But still, I don't know, Mr. Rock Lobster, A, are you familiar with this particular brand of Skew? And then B, do you kind of feel like a lot of people that it really doesn't carry a lot of water?
Well, the one thing is it's like all the junky options. So one, and the second part is, all right, if nobody cares, and it also doesn't really describe the disconnect between call skew and put skew. Everybody puts those together like they're the same skew, and as an SPX trader, they're different skews. You've got a put skew and a call skew, and then you have the at the money vol. So, and you're trading the three things. They're not trading just the skew and the index. So, just to say, all right, these puts are expensive, and then you got to go way, you got to take this call, and you have to say what it's relative to. I mean, the reality is there's probably no bid for upside calls anymore. It's all like gone. And you're dealing with options that are 10 or 15% out of the money. So it's not a very liquid market in the first place. So I think it is a it's a catchy thing, and they could be right. I looked at the history of the indicator. It came up in our chat actually because it looked so fantastic because it was at such a level. And then we tried to just break it apart and say, well, the puts are trading here, and then the calls are trading here. So, I mean, it makes sense. I think it has more to do that there really isn't a bid for the upside anymore, more than that downside put is really bid more than is abnormally bid. But maybe they do have the magic indicator and it's awesome. I mean, it looks like in the past it's worked okay, but it looks kind of like I don't know, 50% of the time if it hits some sort of level. And I also think it might have something to do with the level of the index, because you have to drive the value of the call, and then you have to see what sort of put you have to sell for the value of the call. So it's just one of those things where it's interesting, but it's so far out of the money and fairly illiquid that it's hard to really put your finger on it.
I think you're right, because I wasn't that familiar with this one until this article this morning anyway, and there's so many of these, it's kind of hard to keep track. But I think what all of these different skew indicators really show, whether it's the SIBO one with their kind of obtuse 125 notation to this one, to others, it shows really how difficult it is to disseminate a really valuable and B, easily intuitive skew type number. Because you're right, there are so many different ways to measure it. There are so many different ways. I mean, the call wing and the put wing, even though they're merged together quite often, they're not really the same thing. And so there's a lot of different ways. Maybe that's a project for us here on the program. Come up with the ultimate skew number. I still have a problem with your typical 25 delta call put risk reversal over each other, and do it wherever you like, and taking that number. But again, quoting that is often a challenge, because the puts in most equity and index options is going to be over. So then you have this kind of weird inverse notation. SIBO tried to deal with that by going over 100. I'm not really a big fan of that either. So yeah, I think more than anything, it just kind of shows A, how many flavors of skew there are. B, it's kind of in the eye of the beholder what the hell these numbers actually mean. And C, none of them are intuitive, really at all. So take that with a huge grain of salt, there, listeners. Let's turn instead to something maybe a little bit more intuitive, a little bit closer to home. I know, Uncle Mike, this is hugely in your wheelhouse. You're talking airline stocks all day here on the show. I can't shut you up about United and Delta and all these other ones. Interesting analysis coming across our site this morning. Someone putting up about Delta and what's been going on out there. And Delta Airlines, of course, ticker symbol DAL. They've got earnings coming up on the 14th before the open. So you got a couple more sessions to line things up. Delta hovering right around 46.5 right now, having vacillated down and up a little bit, but right around that 46 handle or so for at least the past week or so. Looking like going into their earnings out in April and May, the near-term months. Calls kind of leading the charge out there. In fact, call open interest pretty much doubling the OI on the puts, at least in the nearer term stuff, like I said, April and May, which is where you'd be focusing your liquidity for earnings right now anyway, which is kind of interesting. Again, I've poo-pooed put call indicators on this show in the past. I think it's kind of overused. It's kind of the low-hanging fruit of options indicators. It's the first one people go to. Apparently now they also go to Skew. I thought that was a little bit farther down the road, but apparently not. But that said, so I don't read as heavily into these as some others may. But still, going into the number here on Thursday, it's clear there is a preponderance of upside afoot out there in Delta. So, Uncle Mike, as our resident airline bull / expert / call you what you will. A, what's your thoughts on all this call love for Delta? And B, I know you're looking at maybe broadening the Uncle Mike Tosaw holdings, maybe in cooperation with that strategic night, maybe separate. I don't know. I know you've been flirting with Apple, maybe back down around the 100 handle. You're talking about getting some Deltas in gold. Anything in the airline sector, drawing your eye these days? Maybe these calls are you. Maybe I spoke too soon.
No, my airline bullishness is grounded, to say the least. If I'm going to be a bull on oil, which I am, I have a hard time believing that airlines are going to be a good holding over the course of the longer term. With that being said, in looking at this, the thing that really sticks out to me in looking at Delta, the front week 49 calls and the 50 calls, there's 10,000 open. There's over 10,000 open interest on both of these contracts. So in looking at this, one thing that one might think, not to steal too much thunder from the unusual activity block, but one thing that one might think in looking at this would that there'd be somebody with a lot of spread money that would be possibly selling a 49.50 call spread, or someone could be long that same spread. So on here, I wouldn't necessarily use just the calls, even though there is a lot more volume in the calls and the puts. But with it, in looking at it, the volatility really doesn't appear to be too much greater on the call side versus the put side. It looks very similar to me when looking at this. So I think that if anything, it's just the same thing that, like you're saying, how you've debunked the put call myth in the past. I think that these could be a lot of short calls, or somebody putting up a lot of short calls as a means to just kind of collect some premium. Because if Delta does have a big earnings announcement, it's still going to have to move. Right now, let's say that you're short the 49 call. That means it's going to have to move $2.50 over the course of the next couple of days. That's significant enough to where it could, depending on what this earnings announcement would be or what happens in the stock, but it's not altogether a bad play if you're kind of concerned with airline stocks and you're looking to be a call spread seller.
Maybe perhaps akin to all the 1x2 love we saw in GLD not too long ago. And since you invoked the odd block, Uncle Mike, I think the rule is we have to now go to it. So it's time. And maybe there might be a little GLD love in there as well. Who knows? We'll see. Because it's time for the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody. That funky tune means it's time for some funky options trades. Yes, it's time for one of my favorite segments. I can't say it's my total favorite because I like your listener questions as well. I know Uncle Mike likes his strategy block. This is probably Andrew's definitely favorite segment because he gets to dig deep into the weeds of unusual activity. And as we foreshadowed earlier on the old program, I'm going to kick things off in the realm of all things glistening and shiny. Start off in the realm of GLD, maybe spread to a few others that are gold related. Of course, GLD, the widely held Spider Gold Trust. Ticker symbol, of course, GLD, closing right around 120 even today, up about 1.5%, as we alluded to earlier. The gold love, the gold bugs still out in force. This name has been putting up some paper of late, about 210,000 contracts. ADV coming in a hair under that today, about 207,000 contracts. Either way, this thing has just been lighting it up of late. If you're one of those open interest aficionados, calls outnumber and puts nearly 3-1 in the OI out here in GLD. So who knows? Perhaps we are getting back to those salad days of mid-February when the 1x2s were just free and open, and you could send your kid to college on the premiums you got for buying those 1x2s. All right, what we saw today was some interesting activity, a bit of a roll of out here in good old GLD. Let's kick things off out in Ape, where we saw the first leg of our multi-leg trade going up. In particular, it was the April 119 calls going up nearly 10,000 times, about 9,700 total on the day, about 10,800 versus 14,500 of the May 125-136 call spread. So closing out, selling in April for about $1.59, closing out those calls. Clearly, those are looking pretty good for him right now. And then turning around and deciding not just to reestablish on a higher strike, but also to put on the old vertical again. So I guess his love isn't open-ended, Mr. Rock Lobster. His love has limits, And in this case, his limits were the 136 strike out here. So our friend is not, he's not just swinging for the fences completely in his mad love for all things GLD. But this trade went up for some size today, total of about 26,000 on the May 125 strike. And let's see how many on the 36s. 36 is about 15. So clearly some other friends piling in here on the 125 strike later, unless he did that on a bit of a funky ratio, which would be odd. All this going up in multiple blocks. Over there on the SIBO, it'll be interesting to see what's exactly how many he put up in that spread on the vertical here as well. It's been a lot. We've been talking a lot about gold upside of late. Mr. Rock Lobster, if you guys remember, longtime listeners, at least for the last 6 months or so, will remember we talked about a June SEP 125 spread went up, a calendar spread went up back in December. This program going up about 75,000 times in GLD. We kind of prognosticated back then how maybe optimistic that was. It was 125 June SEP going up 75,000 times. Paper buying the SEP and selling the June. An interesting one. I think that was more of a roll. Could have been some closing OI there as well. And if that's not enough, Mr. Rock Lobster, we also recently and roundly mocked some, shall we call it, upside fervor out here in good old GDX, which is the Market Vectors Gold Miners ETF not too long ago. In particular, I believe our strike du jour for mockery, Mr. Rock Lobster, was the June, or we should say were the June 22s. Let me pull them up here. Yeah, we talked about paper buying those for a whopping 37 cents, thinking they were perhaps a wee bit daft. And to use some British terms in there, and then it turns out those things now trading about $2.20. So I suppose, Mr. Rock Lobster, a lot to unpack there. We'll start in the GLD, then you can go wherever else you like. But it's been an interesting upside journey so far in the realm of the shiny stuff, has it not?
Well, you know what the most interesting thing is there's been the lack of fading the rally paper. You know, normally when I look at, you look at a lot of open interest, and then you see, you know, there's the sporadic stuff. And then in the trending products like a gold or something like that, you know, there will be, but all the big blocks were buying, buy all the time. And the GLD guy, I'm not quite sure if they made any, they probably made a little money on the apes they traded out of. But I've seen that like the 10, 11 handle call buyers spread before. And this guy, they're loaded for, you know, another run. So they're taking their money and they're saying, I want more of the same action. So I don't think they're done, to be honest. I think they're still, they still want more. They're taking their money and rolling. They're not taking their chips and going away. In GDX, we laughed. We looked at that thing and I go, it was the first rally in gold, and we both looked at that trade and like, wow. And the only thing we said was he's given himself plenty of time, or she is given herself plenty of time. And a month later, the strike that was ridiculously out of the money is now at the money. So GDX is up, what, 85% since the beginning of the year, something like that. And there you have it. So I think all the gold bugs are, the paper for the most part is still pretty bullish.
Yeah, I'd take $2 or about $2 40,000 times. I think you take that too, Mr. Rock Lobster. So that just goes to show sometimes our mockery. You know what this reminds me of, though, Mr. Rock? I was at a conference last week in sunny Puerto Rico. I did take some time I haven't hit the craps tables in a long time, so that was kind of fun to indulge that a little bit. This kind of reminds me of the guys out there playing the horn hi-yo and the hard ways the whole time. You know, they're fun and they're silly, and if they hit 30-1 and they're awesome. But it's not exactly a long-term road to riches or even to staying at the table more than 20 minutes. So yeah, they're not always. That's why we roundly mock these listeners, and also for your listening value, because it's kind of fun to mock some of these. But yeah, this is now too, Mr. Rock Lobster, that we've roundly mocked this, as well as our other ultra-rich friend now out there in Men's Warehouse, who is also laughing all the way to the bank on his seemingly improbable, yet somehow working out in his favor to the tune of many millions of dollars trades. Speaking of millions of dollars, let's move on to one of my favorite names, Mr. Rock Lobster. Of course, Alien versus Predator. Good old AVP. Fine movies, fine films, and they have great options. Oh, wait, I'm sorry. This is actually Avon Products. A far less sexy, far less exciting name to talk about. Let's just talk about aliens fighting predators for another 5 or 10 minutes. If Sebastian was here, he'd be going nuts over something like that. But instead, we'll talk Avon Products. All right, if you make me. Of course, they make all those fine beauty creams and whatnot you see there in the drugstores. This name doing, closing today about $4.85, up a whopping 33 cents, or nearly 7.5%. That's what happens when you stock under $5. Any tick in either direction is a huge move. And this one doing about 4,000 contracts a day of late, doing nearly 8,000 today. So nearly 2x out there in good old Avon land. And what we saw was a little bit of, I think you can call this a departure from the norm, Mr. Rock Lobster. I can probably count on, I won't say one hand, maybe two hands, the number of times we've seen people gobbling up deep, and not fairly deep for this name anyway, in the money puts on this show. Out of the money puts, you can count them all day long. Out of the money calls, pretty much 80% of what we talk about here. So in the money puts, not as often. So kind of an interesting one. Paper coming in, gobbling up nearly 6,000, actually over 6,000 by the time the day was done, of these May 5 puts, doing them on some weird splits, about 57 and a half cents here. Going up with the price variation tag over there on the SIBO, usually indicative of some underlying going up with it. Didn't really see any of those size blocks going up, so that doesn't mean it didn't happen, but we didn't see it in our initial examination. So looks like here this is perhaps what it appears to be on the surface, Mr. Rock Lobster. And no open interest on this strike, so clearly this is some opening at the money, now in the money. They were a lot deeper in the money this morning. So our friend here, an interesting choice. What's your take here on one of our few friends on the odd block to gobble up some in the money puts, and doing so for some size, Mr. Rock Lobster?
I'm looking at that one. I'm saying, well, it looks like you just had a huge rally. Either they own some stock and they're trying to lock in some profits, or they just think the whole rally is a bunch of junk. I know Avon's had all kinds of problems with corporate action type problems, trying to spin something out, not being able to spin something out, activists holding it are upset. So it was I was looking for stock against it because Avon's $4. How much you're going to get out of the 5 put? It looked like either it was kind of a hedge against stock, or just they're looking for Avon just to go back to where it came from. So, and on the face of it, it just, you buy those in the money options like that, you need them to work. So, to me, it's still, for whatever reason, the purchase was not an I like Avon purchase. They weren't liking the Avon lady. Let's put it that way.
I like that. Maybe one of your more salient observations on this program, sir. You buy those options, you need them to work. I like that. It's a Mainer thing to say.
Sometimes you get away with some options. They don't have to work that hard, but you buy those options, they got to work.
I got what you're saying. I get what you're saying. I just like it sounded. I think it sounded pretty fun. So then maybe that'll be our pull quote for the show today. You buy them their options, they got to work. That's what we say in Maine.
Exactly.
On the way to the LLB store. You buy those boots at LLB and they got to work. We're doing work in Maine. These meaty at the money / in the money options, they need to work. I like that, sir. Taking your diehard Northern New England spin, putting it on everything. This might be up your realm a little more. It's not a lot of steel making up in Maine, but you can appreciate some nice cold forged tools. We're talking, of course, Steel Dynamics. This is ticker symbol STLD. I think a newcomer here on the old odd block, closing today right around $23, $22.98 or so, up about 1% on the day. If you're wondering, this is indeed a steel producing and recycling company. And this is the name that does pretty decent paper for an odd block newcomer, about 3,600 contracts a day, doing nearly 29,000 today, so about 10x or near to it of their ADV going up here in good old STLD. And we got a bit of a theme going on here, a few more rolls as April is kind of winding its way towards expiration. A lot of people saying getting out of April while the getting's good, and perhaps, but not closing out completely. Keeping the love alive out there in May. In particular, we saw the APE 22, May 23, so up and a wee bit out here, roll going up about, when we first saw it, about 9,700 times. Total, looks like a little bit over 10,000 on the APEs, which is pretty much in line with the OI, and then 13,500 times on the May 23s. No open interest really to speak of on the May, so clearly opening. So we got paper buy in May and not going away, not going away by a long shot, and selling out their April. Bit of a roll. Interesting name here. Looking back on good old STLD, clearly our friend is not too upset about those APE 22s. They look like they worked out pretty well for him. The chart on good old STLD has been pretty much straight up since mid-February, like the rest of the market, but perhaps even more aggressive. It was trading in the 17 handle, and before that, even down to about the 15 handle back in mid-January. So pretty much straight up run here. Our friend playing clearly with some house money, aka perhaps the size increase on the farther leg. That's usually a good indicator that someone's got some money to burn. They've been hitting those horn high yo's all the way and cashing out now for some decent money. Mr. Rock Lobster, take us home here on Steel Dynamics and a house money roll.
So they both went up as price variation tags. Usually that's a spread or something. I'm guessing they made a little bit of money on the 22s and they're rolling it to the 25s. And Steel Dynamics making a 52-week high, or blew through a 52-week high. So at least today at one point. So somebody likes this stuff. They like it. That's all I got to say. They like the steel. They like the gold. I'm not seeing a lot of love out of copper yet, but maybe that will happen.
Who knows? And meanwhile, while we ponder those great mysteries of life, sir, we shall instead turn our attention to some other great options-oriented mysteries, and hopefully Uncle Mike can help us shed some light on those, because it's time. It's Monday. It means it's time for the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the strategy block.
All right, Uncle Mike, it's Monday. It's time for some options, wit, and or wisdom, laced, sprinkled with a dash of humor and perhaps some strategery mixed in there as well. The people are all set for you, sir, on the on-demand, in the live chat room. They want to hear some options, wit, or wisdom. The floor is yours, sir. Have at it.
All right. So in terms of wit and wisdom, the Cubs are off to a great start this year. Would you guys agree with me on that?
That is neither wit nor wisdom, sir.
Okay. Sorry.
I don't know. I haven't. So what is it only the season is only a day or two old though?
Hey, the Cubs will take what they can get, right?
Andrew's far more concerned about those AAA teams up in Maine this time of year.
Oh, they have AAA in Maine? I thought it was like maybe AA. Oh, well.
I think they do. I think they do have a AAA. Now they have a AA ball club, I think. Yeah.
Look out for my beloved Kane County Cougars coming at you just a couple miles away from us in St. Charles and Geneva, Illinois, by gosh. But anyway, what I want to talk about today is selling a call spread against the stock you own versus selling a covered call. Classic age-old option strategy with which it's pretty much, if you're not, the basic strategy that everybody talks about with option trading is the classic covered call. It's where you're long stock and you sell a call option against it. And the object is to collect some type of income in some way, shape, or form. Hopefully the stock expires 1 penny below where you sold the covered call. The call expires worthless. You feel like a genius and you get to do the same thing month in, month out. And it's just that type of thing that makes option trading that easy. As anyone who's ever traded a covered call before knows, it's not that easy. But what I want to propose today is the concept of possibly selling a call spread versus selling a covered call. Now, let's say that you want to collect a little bit of income on the stock. And no matter what, everything is give and take in option trading. Sometimes you'll hear people talk about how something's more risky or less risky in an option trade. I don't think that anything is like that is necessarily true. It's just a matter of shifting risk. Now, obviously selling 10 naked puts is obviously more risky than selling one naked put. I'm not saying that, but is selling a cash secured put more risky than buying a long call? Well, it just depends on what risk you're willing to take. If the stock were to stay absolutely still, then buying the long call is a much riskier trade because they're a much more of a losing trade, because assuming it expires out of the money, you lose all your money. Whereas selling a cash secured put, you get to keep all your money, assuming you sold the put and it expires out of the money. However, if the stock goes to zero, you lose a heck of a lot more when selling a naked put or a cash secured put versus buying a call. Now, with that being said, I want to go over a way with which I think it makes sense at times to shift risk when trading options. So let's take a look at SPY, for example. Right now, it's after the close on Monday, April 11th, 2016. And I'm looking at some call options. I'm just going to take a look at my beloved SPY. And just full disclosure, I don't have any covered calls in SPY right now. And honestly, I don't think it's a good time to be selling covered calls on SPY. I do have a diagonal spread that I'm in, but on my long SPY positions, I don't have any short call exposure at all against them at this point. I do have some long put exposure as a means of protection. But with that being said, let's say that I want to do a weekly. Right now, SPY expire. Let's say we want to look at the front week options. And I decide that I want to sell the 206 covered call on SPY. I would collect 44 cents for doing such a thing. Now, by doing that, you can argue whether it's a good trade or a bad trade or whatever the case may be, but that's one way with which you can collect some income on this. Now, what that does is that gives you potential upside all the way from 204 to 206, so whopping 1% of upside over the course of the next 4 days. Once again, not trying to say it's a good or bad trade, just trying to show you a way with which to collect some income on this. Now, let's look at an alternative idea for selling a covered call. If you were to sell, let's say you own 100 shares of SPY and you sold the 206 call, you'd collect 44 cents, assuming you get filled what the bid is showing on my screen. However, let's say that you want to sell a 204, 205 call spread. Now, by doing that, you can sell the 204 call for $1.27. However, you're going to have to pay 82 cents for the 205 call. Once again, I'm selling at the bid, buying at the offer. It doesn't always happen that way, but sometimes you can get a little bit of a better fill on it, but just trying to make a point here. So what you'll get on that would be 45 cents by selling the 204, 205 call spread. Now, what I'm trying to point out here is that you can get a similar risk reward or a similar amount of premium coming in by selling an at-the-money call spread versus an out-of-the-money short call. Now, the advantage of that is that if the stock were to go down, you'd get the same amount of money either way. And with that, in terms of the short premium collected. Now, the other advantage is that, let's say SPY really takes off this week and goes up to 215, 220. You get to be a part of all of that, with the exception of between 204 and 205, because that's where you sold your call spread. So those are the two main advantages of selling a call spread versus just a short call. Now, the disadvantage is that if the stock were to go from 204 to 205, you would be losing 55 cents on that short call spread, whereas with the out-of-the-money short call, you actually have a gain because your call expires worthless. Once again, I'm using expiration day logic. I know that's not real world happenings, but I'm just trying to show a point here. So it's a give and take in terms of what you're doing. Now, here's the final thing that I find interesting about selling a call spread versus selling a covered call. As I look at the implied volatilities, and I'm using a thinkorswim option chain, this is just designed to be very basic. The implied volatility on the 204 call is 14.22. The implied vol on the 205 call is 13.55. Now, we've talked about on the show before how when selling a put spread, oftentimes you're buying a higher volatility option than you're selling when you're selling a vertical put spread. When selling a call spread, the benefit of that is that you are selling a higher volatility call than you are buying. Now, there's advantages and disadvantages fundamentally to setting up the trade, but this is something that I like about it. Once again, this doesn't happen every time, but it's something to look for, is that you're not going to be paying a ton of money. You're not going to be paying a lot more money for the long call than what you did for the short call from a volatility standpoint. So that's the other advantage with which I like on a trade like this. So when looking to sell a call or when looking to do a covered call, one thing that I would encourage everybody in our audience to do instead of selling a short call, not instead of, but also just as an added tool to put in your toolbox, look at selling a call spread instead. Sometimes it can make sense for you, sometimes it won't, but I think it's an extremely valid tool with which to look to, and this is something that I look at very frequently and have for years when selling call premium on underlying calls and underlying stock and calls with which I already own. And that is the strategy block for today. Hopefully I have fulfilled the requirements of both wit and wisdom.
Not bad, sir. I think the people are liking it, and now I think we got a little bit of time here on Monday, so without further ado, I like to squeeze in some listener love whenever we get a chance, so let's do a real quick here. Mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, let's see how many we can crank through here in a few minutes at the end of the show. Let's kick things off. The question coming in via Twitter today, it was like more of an ongoing debate / discussion from a bunch of people, 4T7, JF, Hot, a few others wanting to know, talking about the chaos that's been unfolding out there in UA right now, good old Under Armour. And if you haven't been paying attention, listeners, it's been just I think a sell-off is being optimistic, is being charitable. This thing's off about 50%, over 50%, coming in from late last week into this week right now, and it's taking it on the chin yet again today. It was off over 5% intraday, closing off about 5.5% to about 41 handle when it was hovering around about the 85 level this time last week here. So quite a big sell-off, and people, not surprisingly, have a lot of questions what's been going on. Their questions boiled down to, they didn't give any specifics on strike or month, so I can't really speak exactly to this, but my best guesstimate is they bought some puts. They said they're trading about $1.50 before this big crushing split, whatever, call it what you will, corporate restructuring. There's a lot of things going on in the works. They changed their ownership structure. They did a lot of things over there. I think they issued some different preferred shares as well. The stock's down quite a bit. He was saying, why are my puts, which were at $1.50 before the split, now the day before the split, now worth $1.40? Again, I don't know exactly what strikes you're talking here, but probably this is one of those classic event type scenarios where you're going into a big event. Could be an earnings, could be a crop report, could be whatever the expected announcement is. You're going to see a nice bid in volatility. If it's something as rocking and rolling or predicted to be as rocking and rolling out there as what we saw in UA, then it's going to be bid quite a bit. And if you buy stuff ahead of those events and then you see these things unfold, you might see a little bit of that vol coming off, even if the underlying moves your way. Granted, this is the dramatic move, so I think there could be something more to it than just that, but you didn't provide enough specificity here. Get back to us there, JF Hot or 4T7, with the exact strikes if you got them, so we can comment on those perhaps a little bit more specifically. Yeah, of course, I was joking earlier about the thing selling off. It's a stock split, and there was also some other stuff going on, I believe, with Preferred going on out there in Under Armour. But Mr. Rock Lobster, if you want to comment on UA, and we also, actually, since we got running low, I'll have you this question as well. This one's directly for you. This is from Fayecuzername, written in before. Hey, all, quick question. I am a hopium addict at times, one of your favorite terms. Andrew discussed puts and stock rolling down the put as the stock drops. Is the play to buy stock with the proceeds and dollar cost average, or use the proceeds on another trade? This assumes you continue to like the stock. Thanks, you all are my trading methadone. Well, I guess he's addicted, and I guess we're curbing him of that addiction now, which maybe isn't good. I don't know. Either way, Mr. Rock Lobster, talk us through the madness that is the split here in Under Armour, as well as the hopium from Fayecuzername.
Okay, on the stock split, I was just looking at the symbol. It looked like he was buying the July 70, the July 70 strike, expiring this year. On April 7th, they were trading $1.20, $1.40, and it looks like it's a split. I got to do more research into the split, but it looks like it's just 2 for 1. Since then, which means that the strike would now be the current 35s. So the July 35s are only 85 a buck. It looks like the volatility came down. I'm showing the vol now at around 39%. And the volatility on those bad boys before was clocking in right around 39. So the vol hasn't moved too much. So this move, while you didn't get any performance out of them, is a bit of a mystery. Somehow along the lines, some value got shellacked out of there, and I don't have an answer for this one. My sense would be that there is some sort of volatility that has come out of this strike, or there's some sort of adjustment to the strike. But the implied vol is still the same. But it's but we've got a 39 volatility on a $41 stock instead of a 39 volatility on an $85 stock, which is a change in which it's 39 vol is a lot more in an $85 stock than in a $41 stock. So that's what I'll say. So I think what you lost in, let's just say you gained in gamma because you have 2 contracts, but as far as the premium goes, I think the volatility got smashed you on this particular one. So again, looking at where you bought it, it's trading for $81.15. Split adjusted, that would only be $82. So it's only down a couple of bucks, $3. So I'm not sure you're really going to be getting much out of that. That's just not enough of a move to generate any kind of dollars for you.
Yeah, this one's funky. And before you get to the Fayecuzername, just in case I confused anybody, I don't want to, in case they couldn't see through my sarcasm earlier, it was indeed, they issued Class C shares on this one. And it's effectively a dividend. So effectively, it's like a 2 for 1 split effectively on this name, which is why the stock got pummeled. I was using a little bit of hyperbole earlier. I realized some people maybe in the chat were freaking out. What's he talking about? So I wanted to clarify that before we kept rolling. Whenever all these funky corporate actions, we see the stock moving pretty crazily. I agree with you, Mr. Rock Lobster. These puts are a little bit weird. So I want to have him right back with the strikes and the months so we can see exactly what the heck he was talking about. But still, interesting one. Oh yeah, since you got named, Mr. Rock Lobster, what do you have to say for? I'm not sure if it's Fayce or if it's Face. I don't know how to say this handle. Either way, go for it, Mr. Rock Lobster.
The only thing with if you're continuing to roll down puts, okay, that generally means the stock's not going up. So I don't like it when stocks don't go up. Kind of like Marlon Brando and the Freshman if I buy them. So I don't stop. We'll keep rolling the put as you keep getting to the strike. But I do not buy more of that stock with it yet because as far as I'm concerned, you're still wrong. So the only thing that puts help you with is keep things from becoming a total and unmitigated disaster, because at some point the stock and the puts are in the money and there's nothing to lose. You've stopped yourself out by whatever the strike plus the premium is. And as far as I'm concerned, that's all I ever want to lose when I buy puts in stock. If you have to roll them, meaning you've got down to that strike, you have to certainly take a hard look at what's going on in that particular put. You can do one of two things. You could actually buy twice as many puts more out of the money for the next roll. Or you can go take your dollars and you could go just stick them in your account until you find something better to do with them. Because I think at least that point, it's not really helping. The other thing you could think of is you could look at 1x2 call spreads or something like that to give you a little bit more jing on the upside if you're so inclined. But dollar cost averaging, I mean, unless it's a very blue chippy stock, it is a very tough thing to do. The only thing really dollar cost averaging seems to work out for me is just kind of buying the SPY or buying the Qs every month, where you're really not dollar cost averaging. You're more just every month I buy some stock, I get a dividend proceed or whatever, and then I go buy a little bit more with it. But an equity, I mean, if you did that in oil, you rode things down, 65 or 70%. It's very hard. I would prefer just to use the put. I keep rolling the put until I don't have to roll the put anymore. And if things go well on that play, meaning what you've done is you have taken a put, let's say that you paid $1 for, and the stock falls apart and you sell your put out for $8. So you net lost a couple dollars overall, but you're able to book your put gain if the stock goes, and then you roll down to another put, right? If the stock goes right back up again from whence it came, you actually you're doing well and you're up money because you were able to book the winner on the put. So I don't really deviate too much from that strategy. I don't buy more of the stock. Things I might do is I might buy some strangles if the vol is cheap enough, if I really think it's going up. But I mean, there's a point in time where you have to just say, right now I'm wrong. So you take what the market is telling you and you listen to it and you try to keep the loss small, because by the very nature of that position, if the stock does rally, you will do well, right? If you had to roll that put to a cheaper near the money put, you should be doing well because you're able to book a decent gain on the put. So, it's how much you want to leverage it. You want to do more. Then you're kind of in the VRX thing with, what's his name? Ackman. I mean, he's probably going to be right, but he took some pain at the beginning because it kept, cost averaging down from $200 to $30. That's an expensive way to do it.
All right, listeners. That theme music means we ran a little bit long answering your mail, but we love to give you guys some love here on the old program. I'm sure it's not the last time we're going to hear about Under Armour and a lot of these other names. Good questions from everybody. Wish we had time for more. We'll get to more on Thursday's episode of the program. But before we go, we'll kind of do a combo segment. We'll do a quick combo around the block as well as what's coming up in the land of our respective all-star panelists. We'll start off with Uncle Mike. I think he's recovered from that epic strategy block. Uncle Mike, what's cooking in the land of RCM alts?
Call me quick, guys. Not much more time to get those IRA contributions in. 312-212-3531 or send me an email at mtosaw@rcmfs.com.
All right, everybody. And also, one last time, Mr. Rock Lobster, what are you watching for the rest of this week, as well as what's cooking in the land of the pit?
These strange end-of-day vol pops when the market doesn't move. I'm watching those to see if there's any follow-through. I'm watching gold. And if you had any interest in what we just talked about, strangely enough, Option Pit is doing an educational seminar on April 20th on this very subject, one of our famous Saturday classes, which are growing by leaps and bounds and bringing tons of people into Option Pit because, well, they like the commonsensical stuff that we have to say. So if you want to take the course and you said you heard it from the Options Insider Radio Network from other programs, I will be happy to give you an additional 10% off. Just send me a note at andrew@optionpit.com.
Well, so is your class going to be on roll and puts?
Basically, yes.
Well, there you go. Very timely there from Fayecuzername, however you pronounce that handle. Good questions, everybody. And, of course, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing to the show, and, of course, for sending in such great questions. Keep them coming, and all of you folks tuning in via Mixlr as well. We love to see you guys as well. And we'll see you all next time, Thursday, 3 p.m. Central, 4 p.m. Eastern, for more The Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.